Okay. I think I'm live. I will keep checking the comments here just to make sure. You guys might have caught me in a mid-sentence or something of the like, but I am confident now that we're live at least. So that's good. Hello, beautiful people. Captain Zach Sparrow here. So you read the title, maybe you read part of the description there. I wanted to do just another quick live stream, but I wanted to have this one be a little interactive just because it's really hard to know up front any questions that you guys might have. And if you guys did have questions, I would be happy to answer those for you. I do want to preface this with saying, with this particular live stream, because I don't have a lot of time, maybe like 20-30 minutes or so, I know it's super short, but I do not want to deviate from this discussion too much. We can talk about all kinds of things on upcoming streams and whatnot, but like I said, I want to give you guys some more live streams, and here we are, not even a week later, I think, maybe a week later, and that's it. So I want to dive into this, and don't let all of this deter you. I know some of you will be interested in that, and some of you might not care, but I wanted to talk about how much should you invest in collectibles, right? So I used to be a financial advisor. I think a lot of people know that now, in case you're new or whatever the case, but this is not investment advice. This is just FYI kind of stuff, right? Just informational, entertainment type of items here. But yeah, that's kind of what I wanted to touch on today, because I've gotten so many questions around this, and there is not a right answer on this either. So let's jump into this. Okay, so I just kind of want to pour it all out for you guys. So let's do that. Okay. Hey, from the west coast of Canada. That's awesome. I love hearing that. That's super cool. Thank you for that. Pony Pokémon and Josh A. What is up? Thanks so much for tuning in, guys. I appreciate it. So, in short, Zach, how much should I invest in my collectibles? Okay, so up front, I would want to preface this with, again, not investment advice. This is what I would have told people, but this is all relevant information now. So, usually, when you sit down with someone, it's an information gathering session, right? So, why did you rotate your shelf? We need to see the fab boxes. Yeah, I actually don't rotate it. So when I record my videos, I'm like facing that way, and I literally I scoot my chair over. I scoot my chair over that way. I record my videos so you guys see it this way. And this case is quite heavy. So I don't rotate it. It's out of laziness and me not wanting to move it, and the fact that we're actually moving here in the next week or two. I just can't be bothered with it. So yeah, that's that. But yeah, anyway, back onto the topic at hand here. If you guys are just popping in, I don't have a ton of time today, but I wanted to just quickly touch on this for now. And maybe, I don't think we're going to be able to cover everything in as much depth as I would like to. But I just wanted to give you some information up front, just to kind of scratch the surface. So, in short, usually when you sit down with someone, you want to have a conversation of the sorts of, I would just ask them about everything. Okay, what do you do? What does your spouse do? How much debt do you have? Those are really important questions to ask up front, of course. So I know a lot of you know this, and some of you might not, but usually when you sit down with someone, you need to know how much do they make. So let's say, I don't know, $50K a year, and their spouse makes $50K a year. According to the U.S. Bureau of Labor Statistics, I think $51K or so was the average for quarter number 2 for 2021, plus or minus. So about $50K a year is what you're looking at for average. So that's probably the numbers that we're going to go off of today, adjusted accordingly for yourself and your spouse and whatever the case. But when I used to sit down with people, that's what I would ask them. How much do you make? Okay, great. Now, how much debt do you have? We would always, at first, we would ignore, whatever your home would be. Whatever you owe, whatever might be left on your home, we ignore that at first, because that's manageable debt, and that could be seen as good debt. We can get into that on another day, and I'm sure a lot of you already know that anyway. So we would want to look at things like, hey, how much credit card debt do you have? Oh my goodness, did you see how much interest you're paying on that? Are you leasing a car? Do you have any student loans? Things like that, right? So kind of basic information. we would want to know, okay, how much money is going toward that? What are your minimum payments on that? What is the interest rate on that? Once you tackle all of your debt, again, that's a key part there. Once you tackle all of your debt with a few exceptions, very few exceptions, again, your home could be one of them, and there could be a couple. I've seen like a couple of certain liens that had incredibly low numbers tied to them. There are very few exceptions though. By and large, that's what I'd be looking at. And again, talk to a tax advisor and a financial advisor, right, if you want more specific information rather than just vague stuff. The site that I'm on right here is fantastic. I don't see a lot of people talk about this, but Portfolio Visualizer, this is a free site to use. I think you just might have to sign up and put in your information as you say that, put in there. This is really similar. It's not quite as powerful, but it's really similar to tools that I used to use when I was a broker, right? Like, we're talking about a company that's got billions of dollars to work with. And this tool is similar to that. And you guys can use it for free. And I know most of you probably aren't. So I want to bring this to your attention, this Portfolio Visualizer. I don't want to overstate this, but I don't want to understate it either. I'm not exaggerating. Even if you know what you're doing, I believe that this tool right here could change your life. Because I think it's going to show you some information that you might not have been aware of. And even if it doesn't, it's kind of fun to use. It's just cool to look at the what-if scenarios. So basically what we're looking at here is, okay, time period. So how much money are we going to put into a bucket here, Zach? Time period. Let's say our start year was 1972. Why 1972? Because I want to look off of past data, right? I can't look at 2021 and project it out to 2050, right? That hasn't happened yet, obviously. So that's why we're looking in the past, so 1972. And the end year, I just put 2007, number one, because it was before the stock market crash in 2008, but also because of 65. That's 65 years there, I think. So average retirement age, plus or minus, is, I think it's 67 now, but it's around 65 years old is when the average person retires. So let's say you were 30 years old when you started contributing to this and you contributed for 35 years. That is the data that we're looking off of here. Hopefully I'm not being too convoluted. It's just I'm trying to keep this a little streamlined, and again, I'm on a time crunch here. I wanted to get this started sooner, but I couldn't get my thumbnail right. Okay, initial amount for this. So again, the fact that you're 30 years old in this scenario, I'm going to assume and hope and pray that you maybe accidentally contributed to some 401k plans randomly. You worked for a warehouse for a few years, might have gotten a few dollars from selling a couple things here and there. So I'm going to say that your initial investment was, I'll put a line here to kind of help you see the difference. Your initial investment is $10,000. By 30 years old, I hope you have $10,000 in a 401k plan at that point. If you don't beat yourself up. Certainly at 30 years old, that is way better starting at 30 than starting at 40, than starting at 50, and so on. So we're going to assume in this case you've got $10,000. Now, cash flows in this case, this would just be quite literally, how much are you contributing each month? Do you withdraw any money during that time? Did you have a hardship withdrawal, or whatever the case? So let's just assume that you were a good boy or a good girl and you didn't withdraw anything during those 35 years. And you should not, generally speaking. So let's assume that you're not withdrawing anything during that time. And the average amount, again, I'm assuming that you make $50,000 a year, even during that time. Bear with me here. I understand that the average wasn't 50K during that time. It's probably more like 40 or so. Well, actually, I think it was, I don't know. I don't remember what it was for 72. I know for in the 90s, actually, we make about, oh my gosh. Thank you so much for mentioning that. I didn't know I wasn't sharing my screen all of a sudden. I thought I swapped over. Now you guys should see it. Holy cow. Thanks for mentioning that. All right. So, okay. So let me take you back from the top really quick, guys. So Portfolio Visualizer. This is what it looks like here. And I'll try to be cognizant that my head's in the bottom left here as well. But ultimately, Portfolio Visualizer, again, free tool. I think it's really cool. Here's what I clicked on so far. We're doing from 1972 as our start year. we're doing 2007 for our end year. Again, 65 years old. So you started at the age of 30 in 1972, and you're going to be 65 years old in 2007 by the time that you're done, when you're retiring. You have $10,000 starting off. That's your initial investment amount, okay? Again, however you got that $10,000, it doesn't matter. And we're going to say that you made $50,000 a year during that time. I understand that during that time, it's very possible you could have made less, and it's also possible you could have made more of those. So we're just going to use $50,000 as the number amount during that time. So that being said, what is the average amount that people contribute? If you have a 401k plan, it is 7%. If you throw in company match, it ends up being around 11 or 12%. But we're going to say that you contribute 7%. So if you make the average $50K a year and you contribute the average 7% a year, that turns out to be about $290 a month, $3,500 a year. So that's your contribution amount. Are you guys still with me? Again, 10K initial investment, $290 a month is what's going in. Inflation adjusted, yes, that means it's just going to account for inflation during those years. Contribution frequency, again, you're just going to be doing that monthly. We're going to assume that you don't put a like a side bucket away, like in your whatever investment accounts or cash money accounts. I'm reading the comments here just to make sure I haven't lost anyone too much yet. Okay, good. So yes, so $290 a month. And again, we're just assuming that you contribute monthly. And if you, in your case, you contribute annually, you can select that here. So that's a pretty easy thing. Again, this is a really fun tool. And again, this is a very powerful tool. I was, when I first came across this, I was shocked that this was a free tool. I was so jealous at first because this is very similar to what I would use. So it's crazy. It's crazy what people have for free. Like, if you think about it, like, this day and age is amazing, isn't it? Like, you can watch billionaires talk for free, like on YouTube. Like 50 years ago, get out of here. You know what I mean? So I don't know. The internet's a wonderful place. But leverage type, we're not going to leverage anything. We're not going to get super complex in this episode. If you guys would want to see some like trading margin calls, I could probably show you one of my personal accounts. That might be fun for a later video, but I know that's very niche. Let's go with the benchmark here. So what's going to be our benchmark? In this case, I didn't want to import anything, so we're just going to use the Vanguard 500 Index Investor. And with this particular one, okay, what's this, Zach? So some of you might already know. In this case, Vanguard, the company, so they actually have a benchmark that tracks the S&P 500. And I know most of you have probably heard that before. So to keep things simple here, basically just think about this, that our benchmark is the S&P 500, more or less. So portfolio names, I don't need to name anything. Now here's where things get subjective. And I do mean subjective. So here's what I want to break down for you guys. We have a lot of options here. Yeah, let's just jump into it. So when I would sit a client down, again, we're assuming this person is 30 years old and they're like, Zach, how do I make the best hypothetical money in my hypothetical scenario that is not at all investment advice whatsoever? I would say, well, if that's the case here, you're 30 years old, what's your risk tolerance? You know what? I'm not going to really check it that much. I just want to have as much as possible in retirement. Okay, great. That's the same with all of us. And if this person really is not, if they're not sensitive to risk, that's what I'm trying to say here, then yeah, if that's the case, then absolutely we're going to invest in some stocks. I would recommend that regardless of the age. Again, that's what I would have suggested. I'm not suggesting that for you guys. I'm going to stop saying that now. I know I've made that pretty clear. So we've got a few options here up front. And what I like to look at would be sections for our investments. And if you sit, I don't know, 10 advisors down on how they choose their investments for a portfolio, I guarantee you will have 10 different answers. And that's okay, right? It's just like if you sit 10 gym bros down and you ask them what's their workout schedule or what they do to work out. You're going to get 10 different answers for that. it's like anything else in life, guys, right? And it's like when someone asks me, Zach, where do you invest? Do you invest with Vanguard, Fidelity, Schwab, whatever the case? That's like asking someone where they get their gasoline from. It doesn't really matter. They all do the same thing. Some of their rates vary from time to time, but it's all the same thing, right? So, that being said, here's what I would look at. Okay, great. Let's go ahead and look at. Sorry, guys, I'm gonna have to ignore the chat so I can stay focused real quick, and then I'll read. I promise. So here's what I would look at. This top section here. 1, 2, 3, 4. So this breaks it down into U.S. large cap. And bear with me, guys. I'm sorry. I have to say this for the other half of the audience. So large cap in this case would be what? That would be your large capitalization companies. So this would be your bigger companies like your Alphabets, which would be Google in this case, your Amazons, right? That's what this would be. That's what you would be investing in. So if that's the case, you could go with a U.S. large cap growth. And what does it sound like? Okay, so we know it's in the United States. It would be investing in large capitalization companies, okay? Top 500 there. If you're looking at the S&P 500, again, that's our benchmark, right? And what's the difference between these here? Well, a U.S. large cap, when you've got nothing else beside it there, it's just strictly a U.S. large cap, that would be something that would be known as just a large cap fund. And you can see, I don't know, 8,000 different variations of this name right here, depending on what company, what platform you're on. This would be a value. So it would be it would be a little bit less aggressive. You would see more bonds associated with this particular large cap fund. In a large cap growth, you're talking about stocks on stocks on stocks. Does that make sense? And you can carry that all the way through the rest of these too. Mid caps would just be your mid cap companies, so a little bit smaller. Your small cap companies would be most companies. You may have heard the names before. In micro cap companies, you probably haven't ever heard them before unless that's what you do for a living. So let's just go in this case. Let's go with large cap growth. Let's go ahead and pick something else out as well. Let's go ahead and pick mid cap growth. And I'll explain all this in a second here. We'll show different scenarios as well. Well, let's go ahead and go with small cap growth. And let's go with micro cap because, again, this person's relatively young. They're going to be investing for the next 35 years. Now, here's where more diversification can come into play. We're already diversifying, guys. By the way, in case you don't know, this is quite literally diversifying, right? But what do I know? Did I already choose micro cap? I did. Okay. Now, what I would want to do is, well, let's maybe put some money in some international equities, which is the same thing. By the way, this is the same thing as stock, equity, stock, same thing. We're going to get to the really juicy stuff here in a second, too. How does the industry define risk tolerance? We're going to touch on that in the very next section. Whenever I hit analyze portfolios, it's going to break a bunch of things down, and we're going to break down just everything and why some things might make sense for you and why they might not make sense for someone else. International equities. So, global would be just like it sounds, okay? Global stock market. Now, when it says global, you have to be careful because that does also include the USA. Which is fine. I have nothing against the United States. But here's the thing. In my portfolio, I'm already investing in the US, right? So maybe in this particular portfolio, it might not make sense to go with a global stock market fund just because we're already investing heavily in the United States. So you could go with anything else. And again, guys, I am in the United States, so it would show for me European stocks. I mean, that would still be diversified Pacific stocks. Now that gets really specific. Pacific specific. And emerging markets would be just like it sounds as well. So in this particular case, let's just go ahead with international developed countries for our portfolio here. So we got what? 1, 2, 3, 4, 5. And there are plenty of other options as well. Let me see here. So you got those internationals, and then there should be like some cash. Yeah, there we go. There's our, what? This would be like a fixed income section or so. Let me see where they at. Yeah. Oh, yeah, quite literally it says it here. So there you go. Yeah, that's our fixed income. So this is where you put your bonds and your tips and any treasury notes, that sort of deal here. I don't like looking at these too heavily for someone at this age, generally speaking. Again, it depends on their risk tolerance and what their goals are, right? How long are they going to be investing, yada, yada. So, again, for this particular person, that's what I would have been looking at. This is what my mentor would have been looking at. Now, if you look at alternatives here at the bottom, you're going to be looking at real estate investment trusts, gold, precious metals, and commodities. It's a pretty good mix here. So as you guys can see, you got a lot to play around with. So let's go ahead and say that you're going to invest 20% of your monies are going toward just all of this, just kind of a basic portfolio up front. And let's not do any gold. Not right now. Gold will drastically impact the outcome of what your portfolio will look like when it's all said and done. We'll show you that here, maybe, if we have time. It's crazy, though. It's absolutely insane. Okay, so your starting balance was $10,000. So at the end of it all, when you go to retire, you're looking at $500,000. Okay, that's great. Now, what's your compound? Oh my goodness! Look at how much money we've made, and look at the compound annual growth rate. Holy moly, nearly 20%. But look at the Sharpe ratio. It's 0.52. What is the Sharpe ratio? It's quite literally, how well did you do? That's what this is. Isn't that funny? There's a whole system behind this in a way that you derive this information, but essentially 0.5 is literally the market. So 0.5 is good. 0.2 to like 0.3 is like the average. And when I say the average, I mean like the average investor person like Zach, like me, or my buddy. Like that's kind of what you could expect. Statistically, you're looking at like a 0.2 to 0.3 Sharpe ratio. 0.5 would be average as far as how the market performed. Anything above 0.5 is great. And when you get closer to 1, like a full 1 point, that would be absolutely stellar. Like you knocked it out of the park. You couldn't have done any better. Sortino ratio, how the better that number is as well, the higher that number is as well. So with Sortino ratio, that just means, and this is where the risk question comes in. I think it was just a question or two back. So this says, okay, how well did you do compared to the market as your benchmark? And how much unnecessary risk did you take on? So this would be what you would look at in that. And there are a bunch of other factors as well. The Sortino ratio, it takes a portfolio's return and it subtracts the risk-free rate, and then it divides that rate, it divides that total amount, right? And it divides it by the assets, the total downside deviation, if I can remember. Goodness. So essentially what this number does is just what I told you. How much unnecessary risk are you taking on for this particular portfolio? In this case, you knocked it out of the park. You did what the market did, and you didn't take on any unnecessary risk. Same thing. You've got basically 100% market correlation. So what the market did is what you did. And this is what you would have done if you invested in the market. So, hey, Zach outperformed the market. All right. We did great. Max drawdown. This is another important piece here. Well, not really. None of this stuff is important. Here's what I want to outline. It's cool to know what the Sharpe ratio is, but it doesn't matter. It's cool to know what the Sortino ratio is, but it doesn't matter. It's cool to know that the max drawdown that you experienced during a particular point was 34% before you saw it like break even again. So like here, if you look at this, what was this? October 31st of the year 2000, you're sitting at, if you look at the little blue numbers there, yeah, my head's not in the way. I'm just making sure that's what I'm looking over for. You're looking at $272,000. That was October 31st of the year 2000. So in order to, what was that? So in order to, 270. In order to get back to that 270 amount there, you're looking at literally another year of waiting before you get that break even dollar amount again. You see what I'm saying? So I have to be careful how I say this. Nobody gets hurt on a roller coaster unless they jump off, right? Does this make sense though? Um, a year is a really long time when you're contributing every single month and your portfolio is going down or it's staying stagnant. And you're like, dude, I'm contributing $300 a month, right? We were doing $290 a month on top of this just to see our balance go down throughout the years and then just slowly crawl back up. But if you would have held it during that long period of time, you would have seen nearly 20% growth. So that's an absolutely fantastic example. Now, the only thing I'm going to change here is the year. Let's change the year up till today, which I mean, statistically, that person would not be contributing that long, but just for an example to show you how that impacts the rate of return. Now look at the rate of return. Well, why is that? Oh, weird. What happened to this year? Oh, 2008, 2009? Whoa, crazy. What happened during that time? Does that make sense? Okay, now, Zach, you haven't answered my question. How much should I invest in collectibles? So it totally depends, right? So, since you're watching my channel, I'll throw out my opinion on this piece here. And let's compare this to a general stocks bond portfolio of a 60-40 split. So 60% in stocks, 40% in bonds. How did you do during that time period? Spoiler alert. Oh my goodness, you did better. So again, you performed and you did what the market did. And a 60-40 bond split, a 60-40 stock to bond split, you would have underperformed. Not by much, but you would have underperformed during that time. Well, goodness, Zach, I need to have some bonds in my portfolio. Then have some bonds in your portfolio. Just know that you may not, historically you wouldn't have seen as good a growth. Now let's throw in some gold into this mix. Instead of like this international market, let's say that you invested in gold. I love gold. Have you guys seen that Austin Powers movie, Goldmember? That's one of my favorite movies. Same thing, basically. Isn't that interesting? Like, we changed literally 20% of your portfolio to gold. And look at that. All of this is the same. All of this is. Well, Zach, can you explain? I don't need to. What's really funny is you'll find it doesn't take much to find this information either. If you just Google or you YouTube people just talking about the stock market and they're talking about all these different ratios and these bips and dips and whatever the case, I will tell you for a fact that real hedge fund managers rarely look at any of that. They look at how much did I put in, how much did I get out, what is the history of this product, who's the CEO, who is running this company. I'm not joking. That's literally what they look at. They're so like high level. And when I say high level, I don't mean like deeply grounded and looking at every corner. That's what they have their teams do for them. They literally look at, okay, how much am I putting in? What's my potential upside? And what is my downside risk on that? It's really fascinating actually talking to them. I was fortunate enough to be able to speak with some hedge fund managers as well. And they look at the big picture. They look at the big picture. In this case, if you would have invested, the fact that you invested in the market during that time, you won, right? So I think you're kind of getting the hint here, maybe. Hey, Zach, how much should I invest in collectibles? Hey, man, you do you. Is that better than the stock market, though? If you would have invested in Pokemon between 2016 and today, you would have statistically outperformed the market if you would have invested in almost anything. However, I say that with a huge caveat in that this Sortino ratio would have been off the charts. It would have been off the charts. Like you would be looking at a negative Sortino ratio, which is bad, by the way, if you would invest heavily into some sort of collectible during this time period. So does that make it an okay investment? Again, it comes down to your risk tolerance, right? So if you are, let's change this number some more. Let's flip-flop this. Let's do 40% stocks and 60% bonds. That's portfolio number 2. Let's see how portfolio number 2 did. Wow, look at that. Still 14%. Underperforming, 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 right? The more you put in bonds, the more you're going to underperform in the market. I'll also tell you this. Corporate bonds, I know Rudy talks about it, and there's some other channels that talk about corporate bonds and different debts. There are certain companies that invest exclusively in corporate bonds, but they don't outperform the market. You could literally plop your money in the S&P 500 and outperform virtually anything on the planet if you just left it there and forgot about it. That's compounded annually. And you don't have to do anything. You don't have to do this research on the next Tesla stock. You don't have to research what's going to be the next NFT and the next this and the next that. So, Zach, how much do you invest in all of this? Right? Don't tell me what I should do. Just show me what's in your portfolio. Isn't that what they say? So, here's how I look at it. Here's how I look at it. Whenever you're investing in anything, you have to ask yourself, I always ask myself, how much am I willing to lose of this if it literally goes to zero? And will I be okay with that? Me personally, if I put in 50% of my income into collectibles, I would die inside. I would not be comfortable. I would literally not be comfortable. Could I technically outperform the stock market? I could have. I could have. Absolutely. I could have smacked it. However, I wouldn't have been able to sleep at night. I literally wouldn't have been able to sleep at night. I would have been so stressed knowing that literally half of my net worth is in cardboard and paper. So you have to ask yourself that. You could have outperformed it. Now, will it outperform in the future though? Here's the thing. It's so new compared to these companies that have been around for decades and decades and decades. We've got over 100 years of data to look at now. I don't have that. As you can see, I don't even have this as a drop down. I know this is one particular example here, right? One anecdotal example, but I don't have a collectibles benchmark to compare this to. I don't have a drop down of other of where I can put in like alternatives like collectibles. I don't have that option to even compare it to, which shows you how small the hobby can be, right, in comparison. Now, it can absolutely find a place in your portfolio. Now, again, historically, from 2016, if you would have bought before the boom, you could have outperformed. And even right now, here's something I want to let you guys know, and I know a lot of people are talking about this, and here I'm going to kind of answer the question directly at the very end. Even right now, after the boom and after things are falling down, you can get slabs on PSA right now for literally like $8, $10, $12 a piece for old base set cards that are really worth $30, $40, $60. And you're talking about a 200, 300% return. Now that's simple interest. That's different than compound interest, but that would still outperform the market, even if the market... Well, I'll show you. I'll show you an example right now. You can outperform the market right now with collectibles. But it's so risky because it's one particular investment. It's like investing in, like, you have to think about this like if we put in 20% into large cap companies, and then you literally put 20% into Pokemon. Would you be comfortable investing 20% in Pokemon? I would not be. Some people are. Like SM Pratt, I think he's got 90+% of his net worth in Pokemon alone. That guy's crazy in my opinion. I would never do that. Too much work to sell, and also you don't want to depend on it too much. I'm trying to do crazy trades in 10, 20 years instead of... Yeah, here's the thing. What's awesome about crypto is I can liquidate it like that. I can go to the bank and liquidate my money from the bank like that. Even if it's sitting in, I don't know, just some sort of fixed account. Like, I can liquidate it really easily in a couple of days. Do you know how long it's going to take me to sell an Evolutions booster box if I'm selling at market? That's going to take you weeks, months, or maybe even years. It just depends. If you want to sell a little bit under market or throw it up for auction and take a risk, again, taking on more risk, it depends what your risk level is. That's really what it is. But let's look at your initial investment. Let's say, I don't know, let's put a realistic amount. You put in $1,000 as your initial investment, and you don't do any monthly contributions. You just let it sit, right? And let's say after 10 years, let's use a realistic example again, and let's say that the market performs at 10% compounded annually, which is unrealistic. That you would consistently see that over 10 years, but let's just say that it happened. Your $1,000 after that 10 years would turn into $2,500. Feel free to slow this down on the replay or rewind it, but I got to get going here shortly, gentle beans and gentlewomen's. But your 1K would turn into, let's say, $2,600. Okay, now Let me pull something else up here, and I'll drag it over in a second. Now, let's say you take $1,000 and you see, oh, I don't know. Let's do this here. Let me divide this real quick. And you guys can check my math too. I'm doing this on the fly while I'm live. Oh no, I lost my stream. Where you guys at? Oh, there you are. Guys, I am not like tech savvy on this. Like, sorry. Thanks for bearing with me. Okay. So, if you buy $1,000 worth of slabs, and you see that 200% growth, okay, even after 10 years, and it takes 10 years for that $20 slab to turn into a $60 slab, right? Even after 10 years, that $1,000, that would be worth $3,000. You would have literally outperformed the S&P 500. However, here's what you have to keep in mind. And I'm not talking about taxes here, because you're going to live in different states, different countries, that can vary. So we're not talking about taxes. I'm keeping it consistent though. We're not talking about taxes in your retirement account. So we're not talking about the fact that you have to pay taxes on this when you pull it out if it's not a Roth, right? And we're not talking about taxes whenever you go to sell your Pokemon slabs, right? So I hope that makes sense for you guys. Let's see here. I'm trying to think if there was anything else I wanted to go over on this. There's like a billion examples that I'd want to show you guys on this, but I don't have the time for that today. I'm thinking we can show another example. Let's do REITs. And then let's not do anything for this portfolio. We don't need anything. I'm going to re-upload this video, Mick, when this is done, so you can re-watch this and get to the parts that you skipped. Yeah. So look at this. If you would have just invested 20%, are you noticing a pattern here if you would have just switched this? Now, if we switch all of this up here, that's going to change. That's going to significantly change what you're looking at. Whenever you look at trends, whenever hedge fund managers are making decisions, this is key. I think this right here is literally worth thousands of dollars. People would pay $10,000 for a weekend seminar for information like this. And I'm not saying it's because it's me and I'm so great and I'm so smart. It's because I was fortunate enough to be around at the right place at the right time to learn what hedge fund managers did. It was amazing, and it literally changed my life for the better. Here's literally what they would look at. I'm telling you right now that they would get people involved in some sort of large, mid, small caps. Micro caps would vary depending on age. You could literally just substitute this micro cap piece out here with like bonds, for example. And again, this is an investment advice. This is what hedge fund managers would literally look at. No, I'm not forgetting about compound interest. Ashaib, I apologize if I mispronounced that. I'll call you Asha. This is including compound interest. And if you bought $1,000 worth of slabs 10 years ago, and you saw a 200% simple interest growth on this $1,000 slabs, $20 a piece or whatever they would have been, and you sold them for $60 a piece, at the end of 10 years, that would be worth $3,000. So you would have literally outperformed compound interest during that time. But you have to be hyper focused on it, and you have to know what you're doing, and you would have to maybe insure those slabs during that time. I wouldn't insure $1,000 worth of slabs, but you could. And then you're also going to have to find a place to store it. And then you're going to have to throw it up, and then there's time investment in that. How much is your time worth? Now, if you love it and if you're obsessed about this, I think it makes sense to put 5 to 20% of your portfolio in it if you're incredibly bullish on it and if you're sure on it. Like, how much does Rudy have invested in cardboard, do you think? I'm willing to bet that it's, I don't know, 50 plus. Would you say 50 plus percent? I would be willing to bet money it's over 20% though, right? So, for a normal Joe Schmo guy who just kind of dabbles here and there and you're not really super into this, I would literally entirely skip investing in collectibles. That would just be me. Again, that's not investment advice. That's just me. If I didn't keep tabs on this stuff, if I didn't know the difference between a Shining Gyarados and a Lapras VMAX, I would never ever invest in collectibles ever. I would never touch it because the stock market just does too good. I mean, look at this. It's comparable. 2,600 compared to 3,000. And that's if you're doing pretty much best case scenario on all of this stuff. And you have to stay focused on it. So if you don't love it, I don't think it's worth it. We're talking from a specific hyper specific, only looking at this fiscally. I'm not talking about the love of the game and blah blah. I'm not talking about any of that. So, that being said, um, here's what hedge fund managers would literally look at. They'd look at large cap, and they would be looking at growths. They would be looking at growth companies as well. Um, they would look at large, mid, small, and then they'd be looking at some sort of diversification, whether that would be bonds, international stock, REITs, gold, you name it. It doesn't matter. That's kind of like the staple cookie cutter formula. You can cut it out to look at it however you want to. I'm telling you right now, these guys who have more money than God, that is what they do. And I mean, and they consistently average the market, which is really what you should be doing if I were you. Again, that's not investment advice. Let's do another example here. I know I'm kind of all over the place, guys, but I get really excited when I talk about this stuff, and I'm trying to keep it on track, and I'm trying to be quick here and answer. There's a lot going on. I'm like looking at an off screen here. It's telling me that my stream communication is good to excellent sometimes, and then I see comments coming through, and then I have to figure out a way how I can articulate this to you without my head exploding. Like, I'm just not smart enough for all of that, so I apologize if I'm being confusing. I'm like 85% S&P 500 and 15% collectibles. Collectibles are pretty much a hobby, though. Nice, Justin. I can't comment on that too much, legally, other than if you enjoy what you do. I personally don't see like a big whoop in putting that much in your collectibles. Think about it this way too. How much money do you spend going to the movies every month or year? How much money do you spend going out to the bars with your friends, that sort of deal? Well, that's money you could have spent in your portfolio. Okay, get out of here. Everybody's got to live, right? At the end of the day, when I look back on my life when I'm 90 years old sitting on my deathbed, am I going to look back and say, if only I put 5% more into my portfolio? No. I'm going to look back on the times, like the times that I spent hanging out with my friends and everything, right? So I do want people to be careful, though, right? So I personally would not put in more than 10% of my net worth into collectibles. That's me personally. I'm not saying that's what you need to do. And again, this is one person, right? This is one guy here. I'm pretty confident that Rudy has more than that. I am very confident that SM Pratt has way more than that. I am also willing to bet that I don't want to say too many other names, but I am confident that a lot of other people have a lot more money stashed away in this. And it can make sense. To answer your question, Doug, I know you asked this a while ago. It can make sense to where you can literally outperform the market, and this in the collectible side of your portfolio can absolutely outperform the market, but you have to be in the zone with it, and it has to be best case scenario. So when you're talking about factoring in the Sortino ratio and your particular risk tolerance, that is a question that you have to ask yourself. Am I okay knowing that, I don't know, 20% of my portfolio is in physical assets that need to be managed, they need to be maintained. When they get up to a certain dollar amount, I would want to pay for insurance on it. I would need to store it. There are a lot of variables in play. And again, with this, when I turn 60, I can literally just go on to, I don't know, Vanguard and log into my account and withdraw whatever I want to withdraw. And I'll have that money hit my account in the next day or two, or 3 or 4 if they need to verify some things. I can't do that if I've got $400,000. I want you guys to think about this. $400,000 is not a lot of money in retirement, by the way. You're not going to live very long off of that in the U.S. economy today. If I've got $400,000 worth of product that I need to move, and I've got, I don't know, 100,000 slabs that I need to move, how am I going to do that? I don't have any mods here. Do I? Oh, apparently I do. Thank you, mod. Wait. Oh, I did that. Guys, I suck at this YouTube stuff. I was like, click and it says delete message. I was like, is it that simple? That's easy. Okay, I'm going to read through some comments here and then I'm going to dip, guys. Was that helpful? Did that make any sense? I'll touch on a couple other things if you guys have questions around this. But are you going to be able to move $400,000 worth of product when you're 60 years old? Are you going to be able to move it quickly if you want it, like right now? Me personally, I know I can move $400,000 worth of this when I'm 60 in a matter of a day or two. I am not confident at all that I will be able to do that with Pokemon cards. I love Pokemon, guys. This is why I made a channel about it. But from a strictly investment perspective, I don't like it as much necessarily. There's a time and a place for everything. So I think like 1 to 10% can make sense, even aiding your portfolio, but you have to know what you're doing. And you have to follow this stuff regularly. And if you're someone who just kind of hops in and out here and there, I'd put 0 in it, man. Like I would invest in crypto at that point. I would invest in something else. I would not be investing in collectibles and then have to worry about moving it. I don't want to mess with that. No, my time is way more valuable than that. How does the industry define risk tolerance? Is the level of volatility the investor can emotionally stomach a function of net worth or age and magnitude of downside loss can absorb? So again, yes, it absolutely does. And the Sortino ratio, again, is kind of like what you would look at in that case. So again, the closer to 1, the better that would be as well. What I would look at for a particular client would be something like, okay, well, let's still keep you in this growth as well. And here's the thing, when you turn 60 or 70 or whenever you retire, hello, you're not pulling all of your money out from investing at that time. You're not going to die tomorrow, hopefully not, right? You're going to live another, statistically, 27 years, plus or minus, right? So we have to account for that. So I would want my money to work for me during that time. Now, they would say to take out maybe plus or minus 4% of your total portfolio every single year that you could live off of during that time. So I would still want that money working for me during that time. So even if we have a 2008 happen, and oh no, is now the right time to retire? Yes, this is something that I mainly saw my mentor go through. But if you went to retire literally in 2008, okay? So let's see in this case, this guy, if you went to retire 2009, your portfolio value would have been worth $94,000. Okay? Let's say that you retired during that time though. Okay, and let's say that you lived to I don't know, the year 2020, okay? So, I mean, you can see the growth happening here, right? On these portfolio numbers. Play around with this yourself too and ask yourself, how long am I going to live during that time? How much money am I going to take out? Okay, well, I'm only going to take out 4% of this $90-something thousand, right? I'm only going to take out 4% of this $94,000. But if I leave it there and I keep it invested and I hodl during that time, how much money am I going to have throughout the rest of my life, right? So it gets complex, and yes, you can absolutely move a lot of your money to just a fixed income fund that gives you like 1.5% a year. It just comes down to what your risk tolerance is. If you're like, I think it's like 70-something% of retirees don't want to see hardly any movement. I understand that. You worked your whole life for it. I'm just telling you statistically, historically, don't believe me. It's on Vanguard's site, actually. If you literally... I don't know where it's at. You just Google it. If you literally Google Vanguard historical performance, stocks versus bonds. And it's a stark contrast that would tell you if you invested more heavily towards stocks compared to like a 60-40 split compared to a 40-60 split, you would look at 70 something percent of the time the stock dominant portfolio would completely demolish the bond heavy portfolio. So even though it is more volatile, you'll see it dip more, but you'll also see more spikes as well. So that's something to be cognizant of. Man, I know I'm going into the weeds a little bit too much now. Too much work to sell, and also you don't want to depend on it too much. I'm trying to do... Oh, okay, I think I already read that. Yes, I will re-upload this video once it's done. No, we're not forgetting about compound interest. Let's see here. Dude, how do people freaking find the stream that are like weirdos? Alright, I think I'm gonna pop off here soon. Sorry guys, I had to read some creepy comments that I'm sure most of you saw. Sorry about that. Rudy has multiple Florida homes and a lot of stocks, so I don't think it's over 50%. Yeah, I could see that. I'm sure it's over 20, but yeah, I mean, who cares? Doesn't matter, right? Worst comes to worst, and the collectibles hit 0, I still got some Rayquazas. Yes, like you literally have to ask yourself that. If this goes to 0, like literally 0, since you're talking about a single stock, which can absolutely happen, will I be okay? So if this part of my portfolio literally did not perform at all, will I be okay? Yeah, you'll be okay. You'll be okay. But again, that's why I kind of want to mitigate that risk, right? It all comes down to what can you stomach. And that's when you just have a one-on-one conversation with your advisor and be like, hey, you know what? I can't really stomach that much. Well, let's look at 1% in collectibles maybe instead of 5, right? My closet at home and my closet in my college apartment is filled with Pokemon sealed product. I'm scared when I have to transport all this stuff across the country for my college. It's a lot and scary. Yeah, I mean, these are real things, Evan, and you're finding that out, right? Like, yeah, literally. Zach, how prevalent is the use of Investors Business Daily and their... Oh, man. Okay, so... I want to say that it's relevant. It is. It's relevant, but there are literally so many models that aren't like really used. To be totally honest, like I'm not joking. I'm not joking. I would be in meetings where the Sharpe ratio is not discussed, Sortino ratio is not discussed. Here's what's discussed. What has it done historically? What are the fees on it? How much can we make on it? I'm not exaggerating. The rest of this stuff is to confuse the common public. There's a great book out there. I forget the name of it. It's by James Argonante. I can't pronounce his last name. But if I remember it, I'll put it. I'll pin a comment when this re-uploads. He wrote a fantastic book that essentially broke down hedge fund managers that literally made up terms and they justified their definitions and got them to be legalized, so to speak, and put into prospectuses. I don't think it's anything that's on here, but it's literal terms that you would see every day if you actually read your prospectus, which who does, right? This is why I left the industry. Literally, all of this stuff is garbage. Like, what does the Sortino ratio matter to you? Like, right? Like, what does that matter? Like, if you don't look at your portfolio, this right here does not mean anything, right? Like the Sharpe ratio, it's cool to know that, hey, I outperformed the stock market, right? But not by much. Like, who cares? It doesn't matter, right? At the end of the day, I have to live off of this money. I don't care what this little number right here tells me if I did good or bad. At the end of the day, if I did bad, I still have to work off of that, right? So again, I'm exaggerating just a little bit, but not by much. Like most of this stuff it's hogwash, and like I don't really watch a lot of like investors talk online, and like these writers that write this and that, and then they look and they draw these little lines like that start from here, and they draw a straight line. Like watch the my mouse. Don't watch the little doodles up here move. Watch my mouse. Like from here to here, they'll draw a straight line and be like, look at that growth. This right here is called a blah 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 curve, and because this, it's literally made up terminology. Nobody speaks like that in the industry. Nobody does. Let me see. I don't know if I can go over that example now. I think. Justin says, when I think about it, I still think I can move it slowly in retirement. Don't need to jump out all at once, but moving a box or two or a month seems doable. Yeah, absolutely. And another thing is too, Justin, I don't know how old you are. If you're plus or minus 30 years old, which is what most of my audience is. Gosh, man, like 30 years from now when you go to retire, how many other 30-year-olds today do you think are going to try to unload their product where Pokemon was literally their childhood? I haven't really thought that one out too much yet. I don't know. Like I think things will be fine. Like if Pokemon is still going on during that time, you'll be able to unload product. But just know like all of the Pokemon boomers in that case are going to be doing the exact same thing. And yeah, I think a box or two or a few dozen slabs here and there, like you'll be able to move and do. Again, assuming the Pokemon company is healthy during that time. I want you guys to be careful because it's not the stock market. Um, Going on a date with the missus, but love you, Zach. I'll watch this later. Thanks, John. I appreciate that. This is the generation of diamond hands. Hey, that'd be great. Your point about hedge fund managers thinking about management remind me of IBD and CanSlim. It is a practical method that doesn't use jargon. Quality of executive management is one of those. Yeah, absolutely, Doug. I know that you just get it. So it's if I had like a big thing to say, like at the end of the day, I invest in flesh and blood because of the credentials of James White. I invest in service now because of Bill. Yeah, absolutely. Like what does the company look like? Like if you, so here's the thing with all these new up and coming TCGs, by the way. I just wanted to like say my little 2 cents here. With all of these TCGs, there's like a dozen. I don't even think I'm exaggerating. There's a dozen up and coming Kickstarters coming out right now. Are literally all of those going to survive? Even if all of them smashed goals and they've got more than $100,000 to work with now, they've got $500,000 or $1 million to work with. I would want to be speaking with the CEOs. What do they think about natural product attrition? What are they going to do about reprints? What do they think about natural price appreciation for their product? What do they expect the growth for their company to be? How are they going to scale? There are a bunch of factors. I would want to be asking those questions directly. Here's the thing though, and as another speculative play, if you put, I don't know, what's the average price for all of those to buy in? Maybe $100. So let's say that there are 10 new Kickstarters right now. If you put in $100 into all of those and get like a Kickstarter booster box and a weird promo thingy-majig, if you put in $100, so if you put in $1,000 into that, which I think for most people watching this, you've got a little bit of extra cash at least. I don't think $1,000 is going to kill you. If you put in $1,000 in that, statistically, literally only one of those would need to perform, even for just a year or two, to do fairly well, for you to keep up with the stock market or even slightly outperform it. So I'm not suggesting that you invest in all of these companies, but I'm just saying if you talk to all of the CEOs and you believe in a few companies because of XYZ reasons, I could see that being a potential unique addition to the portfolio, maybe a percentage or two, right? Because $1,000, hopefully, for most of you guys, most people I think could afford that. So, do that at your own risk. I'm not suggesting you do it. I'm not suggesting you don't do it, but I'm trying to, again, just expand your brain to where you think about this just a little different, right? So I hope that makes sense. I'm 20. I got a bunch of skies, but I think I'm sort of done after that. Sets seem too good to pass up. Evolving skies, I'm sure. We'll probably pick up Pokemon Center exclusive, excuse me, ETBs, but not much outside of that. So I'm with you, Justin. Yeah, we talked about this in the Patreon as well, but yeah, I don't see the bad in pulling back right now. I think we're going to be in the real Pokemon market now, and that's totally fine. That's healthy. I'm not expecting the market to do anything crazy per se. Like if we have another Logan Paul boom, sure, whatever. But I think we could see years potentially, and just be smart. Just be smart, guys. I personally expect boxes to go up in the next however many years, but I think it could take years to get there. And I think if you're expecting your, I don't know, a Battle Styles ETB to be $500 in 5 years, like what did Rudy say? Rudy said he expects Battle Styles booster boxes to be $500 in 5 years. I don't know if I see that happening. I really don't. Now, I'm not saying they don't need to hit $500 to do great for you, by the way, especially if you got them for like $80 shipped, or even $90 shipped. But I'm just saying I don't know if I see those boxes hitting $500 in 5 years. Um, I if it's what we've seen the 5 years previous to this, I don't think we'll see $500. Like maybe 250, which would still be a great investment, by the way. But I'm saying just tamper your expectations, I guess. I would want to say. You guys have to know this market inside out. The big guys right now, they're not investing in sealed product that much. I can tell you that right now because most people understand that this product probably isn't going to move. They're looking at those PWCC cards. You want to know what the whales are doing? That's what the whales are doing right now. I hadn't spent over MSRP for anything yet. Hey, good for you. Been playing the game since I was 10. That's awesome. That's awesome. So yeah, guys, I hope that makes sense. Feel free to rewatch this. Feel free to watch it on times 2 speed or 1.5 times speed. Again, if you want to talk about opportunity cost, I watch everything on times 2 speed online. It's just I feel like that could be a better use of your time. Just not being sucked into YouTube all day every day. So like everything else, it's balance. I heard a really cool quote today at work. I want to share it with you guys before I leave. I forget who said it, of my team, but it doesn't matter. It was one of the managerial people. They said, balance doesn't happen on accident or something to that effect. So I think that can be looked at with your portfolio, like a balance in your portfolio. You have to be specific and with your intentions, and you have to realize what your goals are. And same thing with life, right? I think you need to, yeah, so balance. Like spend that extra hour with your family. I know it sounds cheesy, but like again, when it's all said and done, like, and not to be gory, but I think about this just on occasion. Like, what if that was the last time you got to spend with your family or your friends? Like, would you really have wanted to been studying curves on a Bitcoin chart? I think it can be healthy to do that stuff and absolutely expand your brain, but do it within reason. Maybe instead of 5 hours of World of Warcraft in the evening, maybe like an hour, right? And then go read a book, go take a walk with your wife, that sort of stuff, right, guys? So I know you know this, but it's so easy to just fall away from all of that stuff, right? Like seriously, go hug your family, kiss your wife, kiss your husband, kiss your brother's wife, kiss someone. Don't forget to reenact one of your comedic intro outros before you end this thing. I don't know. I might have to like go back and record another one or something. I think I just gave you guys one with that at the end. So that's where we're gonna leave it off for the evening, guys. Thanks so much for watching. Thanks for all of your support, guys. I just want to help you guys. If you don't like what I have to say, let me know. I absolutely value your guys' feedback. I understand that I'm not the smartest person in the room. I'm willing to bet most people watching this are smarter than me. I just wanted to share the little bit of experience that I've gained throughout the years. That's pretty much it. You're right. We should study curves elsewhere too. Zach joke. Hey, that's a good joke. I like that. Thank you guys so much. I really appreciate you guys. And until next